So just to sort of give you the brief summary in terms of what the big picture is, it looks like we're getting stabilization. It looks like we're getting a rebound that's synchronized around the world just like the downturn was synchronized. That's starting to feed through into everyone. That's feeding through into exports for Canada, exports out of Asia. You're seeing rebalancings in terms of inventories across businesses around the world. So you're getting something in the very near term, given the data we have so far that suggests it's going to be here at least through the fourth quarter. We think probably the first quarter you start to see a bit of petering out and coming back down to more of a long-run growth. You start to see that coming through the fiscal stimulus leaves, the monetary stimulus leaves, and now the economy has to grow on its own 2 feet. And so some of those damages that are in the economy are going to take some time to work out. And over the medium term, you know, there were a lot of bad mistakes made. You know, when you look down in the U.S. financial system, and you look globally, and it's going to take some time to repair that. And that's going to keep that sort of speed limit of the global economy lower. And for places like Canada that didn't necessarily make the same mistakes, it still means a bit of a lower growth rate because there just isn't the same demand coming from U.S. consumers. They realize that, you know, every once in a while you should save something, or that every once in a while maybe you should have something to put down when you buy a house. One of the most fantastic stories in all of this, I remember at the very early stages when there was still this ungodly debate as to whether, you know, the U.S. housing market would ever crash or not. There was one fellow who had a blog that he maintained out in California. Recent graduate out of college, you know, wasn't really doing much of anything, but he loved to go on this blog and put out the fact that he owned $6 million homes in California. He didn't have any job outside of, you know, I think working at Burger King. But he was able to go in, he was able to get these no down, and he managed to sort of apply at just the right stagger so that no one knew that he was actually applying for all these things. So he had these $6 million homes, he was going to make a fortune flipping them and doing all these things. Obviously the housing market turned and he was left bankrupt and I think divorced, probably not surprising then. But you know, there were lots of these stories that this was just unsustainable, and how we ever had this debate as to whether, you know, it was going to happen or not. There were certainly areas that we didn't know. There were certain things when you talk about subprime, no one in this room, I guarantee, and even myself, didn't know what subprime was before 3 years ago. It became very important and we just didn't know to look at it. And things were changing and evolving so rapidly, you know, that we didn't know to look for it. And it's just going to take time to clear that back out of the system and get back to normal. And so that's what we're sort of going through. You need to clean that garbage out of the financial sector. That's going to take a good 5 years. Consumers, households need to rebuild those balance sheets, need to rebuild savings for retirement. That's probably going to take 5 to 10 years. Deficits by the governments, you know, it's going to take probably at least 5 years, we think, in terms of the Canadian government to get back to a surplus position for the government. It's going to take a lot longer for the U.S., as I mentioned. So, and we have these same issues around Europe, around the world right now. It's going to take time, and we're going to see that sort of slow grind as we move forward. But I think that the message and what I'd like to leave you with is we are moving forward again. And that, you know, at least for the time being, we can tell you at least through the end of this year, it looks like we're getting that growth. And looking past that, it does seem like the worst has been kind of exercised from the system. So I think we're starting to see progress and we're starting to see improvements, and now it's going to be about the longer run adjustments. So I'm happy to take any sorts of questions of areas that I didn't talk about or specific things that you might be interested in at this point. Yes?
Since in your presentation there's a lot of references to the Great Depression, in the crash in 1929, it took until 1951, 1952 for household wealth to recover. Do you see it taking that long this time around, or do you see a much quicker rebound?
You know, part of the reason that it obviously took that long was you also had a world war in between that, you know, hopefully we avoid that issue this time. But does it need to take that long? Probably not, 20, 25 years. It probably depends on how bad, you know, your own individual portfolio was hit in that Great Depression. But it's certainly going to take time. I mean, you saw a number of people that lost 30, 40% last year in terms of the market, and those that were sort of extended even further lost even more. You know, this early rebound this year certainly helps, but you're not going to see 40% returns in the stock market sustained. I mean, you're already starting to see that peter out. So it's going to take probably, I would say, at least a decade. I mean, for someone that was in the market last year and, you know, saw that 30 to 40% loss, you're probably talking, you know, at least a decade to get by. You know, and a lot of them, you know, the issue is going to be how close are you to retirement, and that's going to sort of determine, you The other way to make it back is not just to wait for the gains to get in, but also to increase your savings rates. And so you're seeing that in a number of areas that are just simply having to save a bit more to kind of make that up. But so no, I don't know, 25, 30 years might be a bit long in terms of getting back out, but I think a decade is probably an easy enough position to sense, in terms of getting back to at least the same level we were at before. Yep.
What would the risk assessment be of the atomic bomb in Iran, a shot at Iraq, Chinese invasion of Taiwan? What would that do to this fragile recovery?
Mess it up. I have a hard enough time forecasting the stuff with data, so those sorts of issues. Although I did spend 8 years in Washington D.C. and I'd love to go on for 2 hours about it over beers, but in terms of forecasting the things, it's something you factor in that maybe there's this minimal risk in there, but I don't know that it would actually show up in the sorts of forecasts. In terms of what goes in there, obviously another event in Iran, which is probably the most likely in terms of those things, still nowhere near definite or probable even, but you'd see that ripple effect into the oil markets. You'd see those prices go up. You'd see a shoot up in inflation, and it would raise a sort of question for central banks in terms of what they would do. You still would be unlikely to see central banks respond to a shock like that, because obviously raising interest rates isn't going to do anything to stop the fact that there's a massive shock to the oil supply. And what it would actually do is help your economy contract at a time where consumers are already having to deal with a massive increase in oil prices and gasoline prices. We learned that lesson in 1973. So we try to live and learn from the lessons we have in the past, and we keep making new mistakes, unfortunately. But the one lesson we learned from the Great Depression was put a massive amount of stimulus when you have a financial sector problem. What we learned from 1973 is just because you have an external shock in oil prices, you don't start raising interest rates to try and rein in inflation. So you would get a pretty big spike in inflation, and then the question would become, how sustained is the issue in the Middle East, and how sustained is that shock to oil prices? But I think the biggest hit in terms of the economy would be from the prices, not necessarily from a response from the central bank. In terms of the other ones, it's really kind of uncertain. We're certainly seeing a fragility in the economy, and there's certainly still a lot of issues that need to be worked out in the financial sector. I think the biggest shock would be something, outside of those sort of political risks. I think the biggest risk and the biggest thing that would probably derail this would be another hit to the financial sector. So that's what you would want to, not what you would want to see, but what you would need to see sort of, the big strong double dip would be something, another surprise failure in a financial institution, of the likes of Lehman Brothers, that sort of derails the credit improvement that we're seeing. We already know come next year, banks are still going to be going through a massive amount of deleveraging and trying to recapitalize the banking sector, and that's one reason why there isn't going to be enough credit. Not enough, but there's going to be less credit getting into the economy because banks are still trying to repair their own internal. So to take even more credit out of the system, I think that's the sort of shocks you have to be wary about, something that can actually feed back into the banking sector as opposed to some of the other ones. Something else? No. There you go.
There are some economists that are quite more negative than you are. What assumptions are they taking that are different from you? And you talked a little bit about what could happen. What other assumptions are you saying have to continue to happen to meet your projections?
I think one issue in terms of the different forecasts that are out, throughout the last year, we've seen things change extremely rapidly. When you're looking at how quickly the deterioration came last year, it left a lot of people flat-footed. I think the other area this time is that you're seeing the improvement come extremely rapidly. So it's really only over the last several months that it's kind of been confirmed that not only did we see, the initial indicator, 1 point starts to turn up, but now you've seen 3, 4, 5 data points moving up and up. And so people are just starting to recognize that, just starting to filter that in, that you are seeing this. And then, the guy who covers Canada talks to the guy who covers the US, talks to the guy who covers China, and everyone realizes, hey, everyone's seeing the exact same thing right now. So we're seeing that sort of global turn. So I think one factor is just how quickly you're getting that turning point now. And it's the hardest point to call as the turning point, because until that point, there's no data to go on. But that's what we're seeing. We're seeing an early turn. In terms of what's going in there, I think there's assumptions and questions about consumer spending. And there's a question, people have lost a massive amount of wealth. And there's an active debate in terms of what that actually filters through in terms of consumer spending. Because obviously, you know, the US, it's still 75% US consumers, the same in Canada, Europe, Japan. So what happens with consumers around the world is going to drive the underlying trend.